All right, we're going to cover Chapter 4. You'll find that this is largely review from the courses you've had in the past in accounting and finance. But it is essential for people to remember these as they go through running their businesses and also preparing to present their financial results and projections to investors. So first, we're going to look at the accounting process to remind you how accounting works. Again, you may be finding yourself in the position where you look around and you're the only person with a business background, and you will be asked to just put together financial statements. Of course, you know it's not just anything. So we're going to do a little review in this session. The second is to look at the basic financial statements as, again, a refresher of what is in each and how we can utilize them to analyze different aspects of our business. And third, look at the differences between financial accounting and managerial. There are some very useful things that you learned in managerial accounting. And again, this is a refresher, so you can utilize them in your venture. All right, first, you may find that you are the accountant in your startup. Congratulations, exactly what you wanted to be. But what you'll find is the best combination for startup teams is often comprised of a subject matter expert who could be the inventor of the idea and a business person, namely you. Because of that, you're going to be asked to be the business generalist. You'll be asked about strategy, about marketing, about sales, HR, operations, finance, and accounting. So you're going to have to be confronting this type of process where you go from the left side with a stack of paperwork and perhaps not even paperwork involving things you need to record. In the middle, sort out which ones are necessary and which ones are not for accounting. And on the right, come out with readable financial statements for your internal and external users. So we're going to describe how this works at the beginning of the process, and let's see if you can still remember how to do some accounting. So we're going to utilize this example where we have 11 transactions, and we're going to post them on an accounting statement. We're going to use the accounting template, because if you were to use a system such as QuickBooks or Quicken, more likely QuickBooks for your business, you'll be asked to do these types of basics in setting up your initial transactions. So let's hop out of PowerPoint and go into Excel. All right, so I've brought the transactions over into an Excel spreadsheet. And if you recall the template method, this should look familiar. If not, I'll explain it briefly. So in the blue section here, that's a balance sheet where assets equals liabilities and equity. And we broke out some of the details of what might comprise the balance sheet for your company. On the right side in green is the income statement, and there's a term called articulation, fancy word, simply meaning that whatever net income occurs in the income statement carries back to the earned capital section in the retained earnings. All right, so let's start and post some transaction in our Excel example of a balance sheet or a general ledger. First, the founder invests $1,000 in the company, so we get $1,000. Cash goes up, 1,000. And we have shareholders' equity, common stock, go up by 1,000. So give stock certificate. We give a stock certificate to the founder. Next, we borrow $50,000 from our parents. They love you and they'll invest money in you. So we get $50,000, and let's say it's long term. Next, we have equipment that we lease for $50,000 for a 1-year lease at $1,000 a month. So let's take a pause there. Do we have to record the $50,000? You may recall the distinction between an operating lease and a capital lease. An operating lease is like renting like a car for a weekend. You know, it's short term. You have no pretense of ownership. Whereas a capital lease is like you're buying the asset, but you're just paying for it over time. And in this case, $50,000 piece of equipment that we rent for $12,000 total, I don't think we financed it. We rented it. So at this point, we need to record nothing because it is an operating lease and we'll pay as we go. As we pay rent or it's due, that's when we record rent. But right now, we just leased it. Next, we buy computers for $3,600 in cash. So let's start with $3,600. And it goes down by $3,600. And assets go up by $3,600. And we'll have to remember later on at the end of the month to record the depreciation for this month. All right, next we have inventory. We're going to purchase $20,000 of inventory, but on credit. So our inventory goes up at 20, and we owe our vendors $20,000. accounts payable. So notice that assets, in this case 20,000, equals liabilities 20,000. We're going to sell half of that inventory to a customer XYZ. They're going to pay us 20,000 for it, half in cash, half on credit. So we get $10,000 and we get a receivables for 10,000, and that means our revenues are 20,000. Next, we gave up 10,000 of our inventory, and that is cost of goods sold. So notice right here that the net of our revenues minus our cost of goods sold is our gross profit, or 10,000, and that it ripples through to the balance sheet through this articulation where any net income item is the same as posting it to a summary account inside of retained earnings. All right, next we have money to pay our vendors, so let's do that. We owe the vendors 20,000. So we eliminate the payables here by paying them cash. Item 8, we pay our employees $2,000. And this one's an expense, salaries of 2,000. It's an expense, so it's negative to net income. Next, we have rent. We're going to pay rent for our storefront, $1,200. And that also is an expense, office rent, negative 1,200. Next, we have, we're going to make the payment of the lease on the equipment we saw earlier. So we're going to pay that. And now it goes directly to income statement as an operating lease or a rent. So this is equipment rent, and it's 1,000. Next transaction, we're going to pay dividends of $300. Now this is not an expense. It's money that goes to your shareholders. So it is a reduction in retained earnings. Now it's time to make the adjustment for depreciation. We could do so by saying, okay, what is the amount of depreciation? And let's start building our accumulated depreciation. The amount is negative because it's a contra asset. We take the total cost, $3,600, and we subtract salvage value, of which there is none, so it's just $3,600, divided by how many months that we have. In this case, it's 3 years. 3 years is 36 months. So each month we're going to depreciate $100 a month and build up our accumulated depreciation. So this is depreciation, and it's negative 100. All right. So now we have the makings of our financial statements. First, we make sure we're in balance. So here we see that the assets, it's sum of this section equals the liabilities and equity on this side. So we're in good shape. All right. So revenues, we can just say from above, revenues equals that, 20,000. Cost of goods sold. Cost of goods sold is 10,000. Gross profit is the net, or 10,000. Expenses, we've detailed it out. Salaries, we'll just go up to the section with salaries right there. Grab that number. Office rent, we'll go up to the section here. Office rent, 1,200. Next, equipment rental, that was $1,000 right there. And next is depreciation, that was $100 right there. So now we have total expenses. So we have operating income of $5,700. We have no other items at this point, so our net income is $5,700. Later on, we'll do a provision when it gets close to year end for income taxes. All right, let's do our balance sheet. So we start with cash, and we have it here, $32,900. We have no marketable securities. We have accounts receivable, though, of $10,000, and we have inventory of $10,000 as well. We have no other current assets. We have no marketable securities, but we do have some property, $3,600, and we have depreciation of $100. So let's go net of those. So net PP&E is $3,500. So the total assets equals current assets plus net PP&E, $36,400. On the right side, we can do our balance sheet. How much do we owe our vendors? Answer, 0. How much do we owe others? Also 0. Short-term 0, deferred revenue. So we have no current liabilities, but we do have non-current liabilities. We have debt to our parents, $50,000, and we have no deferred revenue or other. So total liabilities right now is very simple. We only owe $50,000 to our parents. Common stock, we issued that, and that was above right there at 1,000. And we had retained earnings also right there at 5,400. 5,400 is the net income of 5,700 minus the 300 in dividends, which is not an expense that goes to the income statement. So we can check our math. The balance sheet should balance. And so let's see what we got. Total shareholders' equity is equal to 1,000 plus 5,400. And total liabilities is 50 plus the 6,400. And this number, thankfully, equals this number. So we're balanced. All right. So this is just a refresher on how accounting works. We take a big stack of paper. Some are transactions, some are not. We find the ones that need to be recorded. We record each one at a time into our general ledger through an accounting system. In this case, the spreadsheet serves as our accounting system. Next, we do a trial balance to add up all the balances in each of the accounts. And from that, assuming we're in balance, that's the first check, make sure there's no math errors. Then if we're in balance, then we then push forward to the financial statements. We've done 2 of the 4 statements. We did income statement, which we always do first because net income flows into the balance sheet. So it's good form to do first. And then we do the balance sheet. We could do that second or third, doesn't matter, but we tend to do it after the income statement. So we've done the 2 major statements. Income statement here on the right side, right here. So this is kind of equivalent to our green section on top. And then we have this section here, which represents our balance sheet, which is similar to the items on our left. So I'll just shade this light blue just to keep the color theme going. All right, so I hope that was somewhat review for you, because you will be, if you're the founder, probably be involved in setting up the books and making sure the lines in the chart of accounts are what you want to track so that you can use that for your own purposes. All right, we'll go back to the PowerPoint. When we look at balance sheets and income statements, there are 4 statements, the other 2 being the statement of cash flows and the statement of shareholders' equity. So those are the 4 basic statements. And that's required by GAAP. So every single company has those 4 statements. As far as the purpose, income statement tells us how much profit we made during the year. Balance sheet tells us what are our assets, liabilities, and capital as of the last day of the reporting year. The statement of cash flows shows the cash flows broken into 3 activities: operating, financing, and investing, normally presented in a slightly different order of operating, investing, then financing. And then the statement of shareholders' equity, which goes through every change that occurred during the year in shareholders' equity, which includes any stock transactions and also the income statement and dividends paid. So that's the 4 statements. These items, this is a little treasure hunt. Profits are found most readily in the income statement. Receivables are found most readily in the balance sheet. Revenues in the income statement. Unearned revenues is in the balance sheet. Unearned revenues means it's not yet revenues, so why would it be on the income statement? So it shows up in the balance sheet because it's deferred. Later on, we will be recording it, just not yet. Bad debt, we'll see the bad debt expense on the income statement and the allowance on the balance sheet. Cash is found on a number of statements, but notably the balance sheet. Debt is found on the balance sheet as one of the liabilities. Capital lease liability, the hint there is liability, it's on the balance sheet. Operating lease liability, this is a trick question. As we mentioned before, an operating lease is not recorded on the balance sheet. It can be found as a subsequent disclosure, or not as supplemental disclosure in the notes to the financial statements behind the 4 statements. Next is the amount of new stock issued. That is found on the statement of shareholders' equity because it's a change in equity during the year. That statement shows all the changes. Dividends paid can be found on the statement of shareholders' equity, reducing retained earnings. Total common stock can be found in two places: in the balance sheet, where it's a required line item, and in the statement of shareholders' equity, which reconciles the beginning to the end of shareholders' equity, including common stock. And details on why the stock changed, statement of shareholders' equity, because it has to explain, again, everything that changed from the owner's standpoint in stock, profits, and dividend. All right. So next learning objective is comparing financial accounting to managerial. Which one is better? I could put it in quotes because you can tell this is a trick question. The answer is we need both. We need financial accounting for the basics that we need for running our business day in, day out, to receive cash, pay cash, keep track of the books. But we also need the statements to provide to internal managers as well as external users like bankers or investors. So there are 4 items I want to cover with you in managerial accounting. Again, this should be review for you, but I want to just remind you of these 4. First is a balanced scorecard. Second is cost behavior in terms of fixed variable costs. Break-even analysis, or cost volume profit, utilizes those differences and the profit equation to gain some pretty valuable insights for not a lot of work. And finally, I want to touch on the functional income statement, which looks like our traditional GAAP financial statements, compared to managerial accounting, which is useful for internal and typically not shared with anyone outside of the company. So first, balanced scorecard. It looks at a measurement system of metrics that we have from the standpoint of several perspectives. What are those perspectives? They're financial, customer, internal, and innovation and learning. So what we want to look at is what is a small number of metrics, let's say 3 or 4 in each of these 4 categories. And if we measure them, how are we doing? So it tends not to be redundant, like earnings per share and net income and increase in equity, right? That would be redundant. So we choose those carefully because we want that to be a fairly short list of key metrics. So one of the reminders I want to give you is remember that what gets measured gets done. So if we measure these 4 and people see it, they realize that must be important to senior management and owners, so it'll get done. If you say, what is the number of days without an industrial accident in our factory, and every day when your workers come in, they see number of consecutive days without an accident, they know that, oh, this must be important to our owners, and thank God, because it's our safety. So they will see it and see that reminder and not want to break their streak. So that's just a simple example of what gets measured, gets done for the good of everyone in this case. All right, some of the indicators. If we look at financial, it could be cash flow, ROI, or sales. Customer could be market share or market size, or number of customers per hour in the throughput, or complaints, that's a negative we want to reduce. And the returns, similar, that's a negative we want to reduce. But it's important to measure it to get a measure of the happiness or satisfaction of our customers with our products and the performance. Operating could be things like products produced versus sold, to look at our efficiency to turn inventory into money. And then utilization of capacity. Did we build too big a factory, or did we build too small a factory? We want to measure utilization to track where we are in fully utilizing our productive capacity. And then turnover. We want to manage so that our turnover does not occur with the people we want to keep. We hate it to hire people, bring them aboard, get them productive, and have them leave. So we measure turnover as an indicator of something we watch, because it's important that we keep the good people that have contributed and will contribute in the future. So growth and innovation, these are a little tougher, but it might be how many products did we introduce this year that are contributing to our revenues? How many did we discontinue? Kind of trimming or pruning our product line so that we can keep things fresh. Number of sales promotions. Are we actively pushing people for trying our products and hopefully finding that it suits their needs and preferences? And are we active in discounts, promotion, and other marketing and sales support? Oh, last point is that we measure these balanced scorecards and we share them. We, of course, would share them with senior management and probably the board of directors. But I have found, particularly in a small company, that the more you share with your employees, the better. So I would share with this to employees, what are the metrics we consider important? And we're going to show you how we're doing, because we're all kind of in the boat together.